Well, if you just look at the track record of the UK industry over the last 10 or 20 years, it's been abysmal. The average pension fund's funding ratio has fallen by 20 to 30%. The industry today has a funding ratio of 50 to 60% as a whole. And if you just try and think what's gone wrong, risk hasn't been managed, and trustees have been very slow in making asset allocation changes. And so it seems obvious to us that something is broken about the current model. The argument in favour of delegating would be that a team of full-time investment professionals who are actually operating in real time ought to be able to do a better job than lay people who meet 4 times a year. That should come across in more decisive action on asset allocation, better risk management, as well as taking advantage of opportunities that present themselves, particularly opportunities in a crisis.
You need to tactically adapt the portfolio both to anticipate and to take account of what's going on in the world. Now the question really is then who's best placed to do that? Is it the investment manager, the implemented consulting firm, or a fiduciary manager? In the case of the investment manager, you can see what us and other people have done, how much risk we've taken, what results we've achieved, what the portfolio looks like, and so on. With the implemented consulting firms or the fiduciary managers, I just don't know whether they're any good at it, what the proof statement is.
Sure, I think the best example over the last year has been our call on equities. We were bearish for some time last year, and we went to all of our clients and advised them to sell or hedge all of their equity exposure before Lehman's went bust. It was interesting because advisory clients found it quite difficult to digest the advice. Some took a long time to think about it, others couldn't reach consensus amongst their groups and therefore did nothing. Where we had discretion, we moved decisively and quickly, we hedged the equity risks, and we have now, in this year, started putting risk back on the table in a more material way.
If I delegate the whole thing to someone else, and I don't know who that fiduciary manager is appointing to actually manage the assets, i.e. the investment managers they choose, how do I know that I'm not going to end up having my assets being looked after by Mr. Madoff, or all with Lehman Brothers? What's my counterparty risk? What happens if the whole thing blows up? Am I negligent? Have I really done my due diligence on the people who are looking after my assets? That's the difficult question for the trustee.
The legal position is very clear. Trustees are responsible for everything that they don't delegate. So provided they've delegated to a competent organisation and been very clear about the terms of the delegation, then we are responsible. And we think it's very important that trustees delegate managing the funding ratio, so it should be the solvency that is delegated to us.
If you and I are trustees and we wake up one morning and we see that Madoff has effectively collapsed, we want to be able to pick up the telephone immediately to our investment manager and say, do you have any exposure to Madoff? Now if you do that with a fiduciary manager, that fiduciary manager's got to check with all the underlying managers. And if it's a case of Lehman and counterparty risk, he's got to check that the underlying managers have no assets which have been lent out to Lehman's subsidiary and all the rest of it. You're just getting further down the food chain in terms of knowing what's going on, and the transparency of it is very important.
Our job is to improve the solvency of the pension fund, taking as little risk as necessary. And that's the basis on which we should be judged. It's also the basis on which our fees are struck, so we get paid for improving the funding ratio and we don't get paid if it doesn't work.
I do know that on a presentation we made recently to a 250 million mandate, that the difference between appointing an investment manager or a fiduciary manager was going to be at least £1 million a year more to have the fiduciary manager. And that scheme has to decide whether that £1 million additional money is worthwhile or not.
Sure, and we don't imagine that every pension fund should delegate everything to somebody else. I think that there is also room for pension funds to do both. One of our clients, ASDA, has some of their assets delegated and some of their assets on an advisory basis, and it allows them to get the best of both worlds.
The trustees have got different options, different models to look at. But what I would say is that ultimately on the investment side, it's all about how you manage the assets. And in order to be able to compare and for people like yourselves to make judgments as to which option is better. We need to have totally transparent disclosure of performance from the fiduciary managers, the implementing consultants, and the investment managers, totally transparent risk and totally transparent costs. And then we'll all know who's doing better.